What if the company that claimed it would power America's clean energy future suddenly began acting in ways that contradict every norm of how a large-scale energy infrastructure enterprise is supposed to operate? What if the very firm that promised investors a nationwide green hydrogen network instead dismantled its own roadmap, not gradually or strategically, but with a kind of abruptness that defies industry logic? And what if the sequence of decisions was so irregular and so out of pattern that seasoned investors found themselves asking the most disturbing question of all: why exactly is Plug Power behaving this way? To understand why this question has become unavoidable, we need to reconstruct Plug Power's official story before it fractured. In the standard model of industrial expansion for an energy infrastructure company, the progression follows a predictable chain. First, a firm secures upstream production capacity. Next, it builds stable midstream logistics for transportation and storage. Then it expands downstream applications that rely on that controlled feedstock. Finally, it locks in long-term economics through vertical integration, meaning ownership of every critical link. Plug Power embraced this model with unusual intensity. By about 2021, the company operated hydrogen plants in Georgia, Louisiana, and Tennessee, each producing around 40 tons of hydrogen per day. These were the foundational assets behind its next move: a rollout of 6 new green hydrogen plants across the United States, each engineered for roughly 15 tons of daily production. To support this massive build-out, Plug Power secured a conditional loan guarantee of around $1.6 billion from the United States Department of Energy in 2024. Loan guarantees of this size come only after intense technical validation and economic scrutiny. Under normal circumstances, this is the moment a company accelerates construction, deploys capital in structured phases, and provides routine engineering updates that guide investors through milestones. Instead, something deeply atypical happened. In November 2025, Plug Power abruptly paused or halted development of every one of the 6 new plants. There was no comprehensive engineering report, no detailed cost escalation analysis, and no staged renegotiation with the Department of Energy. In the energy infrastructure world, major project changes almost always involve transparent communication, extensive feasibility updates, and advanced notice. Plug Power offered none of this. Even more baffling, the company declared it would rely more heavily on third-party hydrogen suppliers, which directly contradicts years of its own claims that external sourcing would destroy margins and destabilize operational reliability. This is the first major mystery. Why dismantle the core of a vertical integration strategy so soon after securing a multi-billion-dollar federal guarantee? Why provide no data-driven justification? Why pivot from owning hydrogen production to buying hydrogen when the company had spent years insisting that buying was economically inferior? The silence around these shifts is striking, and silence is rarely random in this sector. Before the market could digest this reversal, the second anomaly emerged. On November 18, 2025, Plug Power issued nearly $400 million of convertible senior notes maturing in 2033 with an interest rate of about 6.75%. Debt issuance is common. What is not common is the sequence. Standard corporate finance behavior is that companies borrow long-term when they are expanding, not right after they cancel expansion. When borrowing follows contraction instead of preceding growth, investors tend to assume something unspoken is happening in the liquidity picture. Then came the third irregularity. Plug Power announced a special shareholder meeting set for January 15, 2026 to double its authorized share count from 1.5 billion to 3 billion. In typical corporate governance, expanding authorized shares aligns with major acquisitions, long-horizon projects, or accelerating investment cycles. Plug Power's timing, however, suggests the possibility of future dilution to fund survival rather than to fund expansion. Layered on top of this is Plug Power's deteriorating financial performance. Revenue fell from around $900 million in 2023 to about $630 million in 2024. That is roughly a one-third decline. Losses ballooned beyond $2.1 billion. Quarterly cash burn repeatedly exceeded $100 million. Ordinarily, companies in this situation stabilize operations, freeze capital expenditure, and avoid aggressive dilution to protect remaining shareholder value. Plug Power instead executed contraction, fresh debt issuance, and share expansion all in rapid succession without offering a coherent explanation. This is the core of the mystery. These actions do not align with each other. Expansion is paused without technical justification. Debt is raised without corresponding growth investment. Authorized shares are doubled with no clear strategy requiring them. Revenue declines while the long-term vision becomes increasingly ambiguous. Losses widen even as the company hints at a pivot toward powering artificial intelligence data centers. That pivot might be compelling, but it remains undefined and unsupported by cost models or market sizing. This suggests Plug Power may have encountered undisclosed engineering or economic barriers to hydrogen production. Another possibility is an attempt at a rapid strategic realignment toward data center power that the company was financially unprepared to manage in an orderly way. If this pivot was intentional, it arrived through scattered hints rather than through the structured communication that usually accompanies major strategic transitions. Market behavior reflects the uncertainty. By late November 2025, the stock hovered near $2, sitting beneath the 20-day moving average near $2.3 and the 50-day average near $2.7. The 200-day moving average is near $2 and functions more like psychological support than a sign of renewed strength. The relative strength index sits in the mid-30s, showing persistent selling pressure. The moving average convergence divergence indicator remains negative, suggesting sustained downward momentum. Support forms around $1.8 to $1.9 with deeper support near $0.7. Resistance appears around $2.1 and again in the mid-$2 range. These technical conditions are not random. They are the market's attempt to price in a strategic uncertainty that has not been resolved. When a company's narrative fractures, price action becomes the proxy through which investors measure undisclosed risk. And that is what makes this moment so important. Plug Power, which once positioned itself as the architect of America's hydrogen future, now shows signs of internal contradiction. Vertical integration, once described as essential, appears abandoned. The company that secured a massive Department of Energy guarantee is no longer building the facilities tied to it. A company that dismissed going concern fears in early 2024 now issues new debt and prepares for possible dilution. Yet the ending is not written. Plug Power still holds valuable technology in electrolyzers and fuel cell systems. A recovery in margins, greater operational discipline, and a clear strategy could rebuild credibility. But until the company resolves the inconsistencies between what it said, what it planned, and what it is now doing, investors are left navigating through support and resistance levels instead of strategic clarity. And now a quick word to listeners in a way that fits the flow naturally. Our Value Stir community grows when you share what matters. So if there is any listed stock, unlisted stock, upcoming IPO, or digital asset that you want us to cover next, tell us in the comments. We really do rely on your ideas to decide what to investigate next. So drop your suggestions and let us know what mysteries you want unraveled. And of course, we want to thank all of you who watched, subscribe, comment, and share our episodes. Our most dedicated listeners are the reason we keep pushing for better, deeper, and higher value content, and we appreciate every bit of your support. This was Value Stir.